Welcome to Zen and the Art of Real Estate Investing, one of the fastest growing real estate investing podcasts in the world. What if you could learn from experienced real estate investors? Find out what got them to where they are now. Get insight into their daily habits and take these insights to inspire your own growth. Each episode, Jonathan Greene shares an in-depth look at the mindful approach to real estate investing. Jonathan is a lifelong real estate investor and the founder of Streamline, a data-driven, investor-friendly, independent real estate brokerage located in Madison, New Jersey. Whether you're looking to start from scratch, get to the next level, or just for a straightforward and honest approach to real estate investing, this is the free mentorship program you can take with you anywhere. Now, here's Jonathan.
Welcome back to another episode of Zen and the Art of Real Estate Investing. My guest today is Ryan Cadwell of Resolute Realty, Development, and Management. Their mission is to catalyze positive change in the real estate services industry, and that's why they merged all of these. They create opportunities, develop thriving communities, and enhance the lives of those they serve. Let's get to it. This is episode 320 of Zen and the Art of Real Estate Investing with my guest, Ryan Cadwell. Ryan is a partner at Resolute RDM, which stands for Realty, Development, Management. They are an Indianapolis-based real estate firm specializing in commercial investment and property management. Ryan's been in it over 17 years. Welcome to the show, Ryan.
Thanks, Jonathan. Happy to be here.
Yeah, I'm looking forward to talking to you. And I want to start with something that I read in the pre-stuff that I send out. Why do you think dumb money is making it harder for us, long-time investors to get in there? There are a lot of people messing it up, and I agree with it. But what do you think the dumb money is, and what impact is it having on other investors?
So dumb money is good and bad. It's good when you're selling and you're making a lot of money.
Yeah. I like a dumb money appraisal across the street, right? I mean, a comp.
Yeah. It's bad when you're trying to reposition the same capital and not make the same mistake that the other person did. So, how is it? I mean, a lot of it just comes just from the natural cycle of COVID. A bunch of free money enters the market. Lending rates dip to unreasonable numbers. I mean, I know why they did it, but and then it just turns into exponential. Everything just gets multiplied out, and so, and I think there's some people that I've even followed during those times they were doing some investing, and then to listen to them then and then listen to them now. And they're talking about the new ways that they're underwriting, and I think it just has a lot more to do with just staying disciplined, know who you are, know what you want.
I think to me, there's also dumb money is also inexperienced money. So, like you said, they have some capital to throw around. Maybe they think real estate's easier than it is. Especially when rates are low. I mean, it is pretty hard to miss when you're getting it at a 3% rate. But now, if you have to reposition that loan and you can only get a 7.5, you're in trouble.
Yeah. And when you don't pressure test it, and one of the things I figured out before this cycle, I used banks as kind of like a backstop for me to not make mistakes. And several of my lenders are great. This story doesn't necessarily apply, but I was asking them, why are some of the lenders doing these deals? Like, they've been in it long enough to know that the cap rates are just going to go up. Like, they're not going to stay at the floor, and that's just going to have a major problem. That's going to create a major problem. And they just described to me basically that a lot of banks that are publicly traded, they don't necessarily, they're worried about their valuation on the stock exchange.
Yeah.
So doing loans that are dumb, it's a calculated risk. They know some of these are going to fail. More of these are going to fail than some of the other better underwritten ones. But they're looking at 3 to 6 months out, and our valuation has to be X. And once I heard that, I realized okay, I can't really use lenders as a backstop.
Different priorities.
Yeah. I mean, and their priority really is to get me to take the loan.
Yeah.
And then they do the deal where it's 30% or, sometimes it was 20 and 25. I've seen some people get 20 and 25 down. And to them, they've pressure tested their numbers and they know that when the market shifts, ultimately what gets wiped out is the investor's equity,
Yeah.
not their loan.
Yeah. And they're more of a machine. They can withstand it, and they're a volume-based business. So more volume, the better. And like you said, they're just calculating some runoffs in there. It must be interesting though, because you're in Indianapolis, right?
Yeah.
Yeah. Indianapolis is always like, in the top 5 markets to invest in. So you probably get a lot of out-of-state people interested in, but I wonder if they really understand the market. Of course, that's part of your job to help them, but maybe they, want to do less due diligence just because it's always on a top 5 list. And honestly, it is a great market. I know a lot of people who have investments from single families all the way up to large scale multifamily. But how does it work out for you when you get those non-local people coming in? Because I'm sure there's a little bit more advisory going on there.
That's our goal, is to have a little bit more advisory. Where it turns into different forms of friction is if they bring us in just for the management after they've acquired it, and the broker they worked with wasn't really. A lot of brokers can advise, but the advice they're giving is usually transactional based. It's usually them saying the market says this, as opposed to, okay, what's your investment criteria? Why? Like, what are you really planning on doing with this?
Right. It matters if they're going to turn and sell in 3 years, if they're looking for a lifetime hold. I mean, I own my own brokerage, and I've said a million times, like, most realtors know nothing about investing. I think only maybe 1% can really counsel investors well. And that does put you in a hard spot because they've set them up with a property that they said, oh, looks good, and then you have holdover tenants that are leased for an extra year and a half, at way under market value, or they don't calculate the capex, which is, the classic, because realtor, frankly, they just didn't know that both furnaces were old and were going to come due right away.
Yeah. And I mean, that even just turns into like the gray hair that we have. I mean, that some of that is just straight up experience, and it doesn't have to be. I think that's probably the most common misconception that we run into with clients is so many brokers, and I don't think any of it's intentional. I think it's just they don't know what they don't know. And I was one. I mean, I've been a broker 18 years, and early on I was ignorant too. But investing is just a whole nother animal, and helping me buy a property is not helping me invest. That's helping me spend money.
Yeah, and it doesn't serve. Like I always tell people, I'm focused on the asset. You can get as emotional as you want, even if it's an investment, but I'm still going to vet the asset. And I've always found, and I'm sure you as well, when you tell people, no, this isn't a good deal, the good ones will respect you more. And the other ones were just waiting for a yes from the next person. So let them just tell the next person, that's fine. I don't want that on my conscience anyway.
100%. And that's, and a lot of that has even been how I've tried to kind of change our value proposition to clients is, hire me for the money I've lost. Like, let me teach you, at least let me look at this property through the lens of my mistakes or other mistakes I've seen and had to help people out of. I mean, coming out of, we started right at the beginning of the first recession. So we had 4 or 5 years of just cleaning up other people's messes.
Yeah.
So yeah, I mean, it's one of those things where you just wish that people, I mean, it's human nature thing. It just slow down, like slow down. And I'm guilty of not slowing down. Like, I'm not going to sit here and throw stones.
Yeah, we've all done it, but I think people are, they're watching 30-second clips of everything. Everything looks so good. Like it seems like things should move fast. But yeah, I really agree with you. I don't think people are taking the time, and advisory is a better thing. They need people to tell them the truth. I've always said also, now of course we're at episode 320. Look, over 320 episodes, every person who I've had as a guest on the podcast has told a screw up. Why would somebody want to go and do that exact same thing again in that
Right.
market when we're all here to tell you these are the things that definitely work based on our real life experience? And instead, they might want to buy a guru course or just watch a video and say, ooh, Section 8 sounds great. Let me get into that. That's what scares me. And that's hopefully who, we're both here to help. Whether they listen or not, there's not really much we can do about that.
No, there's not. There's
You
not.
know?
And it's whether they want to hear you. I
Yeah.
mean,
Yeah, I agree.
and the timing. I mean, we never step in the same river twice, and
We
and it's
shouldn't.
where they're. Well, you hope, you hope not.
Yeah.
At least build yourself a bridge.
Yeah, I mean, but like we were saying, there's always a person who's going to call up, 6 different brokers and just wait for someone to say, yeah, it's a good deal. At some point, someone will find it to be a good deal. That doesn't make it a good deal just because you want it to be a good deal. And also I think people think real estate is, I don't find real estate personally risky at all, but I have a very high risk tolerance and a long history. And if you wait long enough, it's really generally not risky. But I don't think they appreciate the risk, especially obviously if you're looking at it from property management lens. A lot of stuff comes due that you don't expect. You can do all the inspections you want. Stuff's just going to break. Things are old. Houses are old. Apartment buildings are old. There's things that come up that you would never have thought of. It just happens.
Yeah, and the only thing you can do right there is know that expect the unexpected and know stuff's going to break. Like
Yeah,
if you go into this thinking and you're surprised by that, that's the mistake.
yeah. Yeah, I hate when people do only the best case scenario, because if you factor the worst case scenario, you're kind of always winning. And then you feel like, oh, you're pumping yourself. And also it's reserves. If you close anything and you don't have reserves, you're basically telling yourself nothing's going to go wrong.
Yeah.
That's asking for it.
Oh yeah. And going through the, after the recession, there was a few years, and then that led into for us in Indianapolis, that led into the whole turnkey phase where everybody you had a bunch of investors buying stuff, putting lipstick on pigs and moving the product. And we had a mixed bag. We had partnered with somebody that was doing that. And there were people that loved it. They got great deals. The properties didn't have any problems. We had people that hated it. They got a lemon. Whether or not, something was overlooked, I don't necessarily know. I wasn't always a part of, I was never a part of the first transaction.
Yeah.
But I mean, just in watching so much of that go through, and even, I'm 18 years in, and one of the things that I have to get better at is knowing what I want when I'm buying a property. Like, if I don't know what I want and I don't know what's the definition of success is, then why am I doing it?
But that's you after 18 years. So we have to respect the newer people who are really clueless. But, again, we're just trying to help you. I agree, because I still do the same thing. Like, I'm trying to get back into short-term rentals, but I keep not pulling. Like, I made a couple offers, but it's just I think a tighter buy box is better. But a lot of times when people start, they're just like, like they'll call it, just anything like in Indianapolis. And you're like, well, it's a little bit bigger than you think. It's not like 7 blocks, to choose from. And then I don't, as a broker or any type of advisor, I don't want to make the decisions for them. And that's where it's like, do you go through this kind of, pushing the ball back to them? It's like, you have to make the decisions. I'm here to help you. I can't make the decision. I can't tell you which neighborhood is better. That's up to you. And it's up to you, like you said, what you want. Because turnkey can work. if you're looking for, modest cash flow, light appreciation. But I think people get into it with the wrong idea. And some companies don't do a good job. Some are very transparent and you can look at it and you're like, yeah, I'll take the cash flow. But also they're selling for 150 and usually in an area where all those other houses are still 90 because they're the first one to go up. So your real, I don't know how they appraise, but I look at it and then I never pull the trigger on that as well, because it's just like I'm an asset hunter. I'm looking at the value and the value doesn't match up for me.
Yeah. Yeah. And that's always the interesting thing is value and the different forms of value that,
Well, because people think cash flow is really the value, right? I mean, it's why people, a lot of people will go to the Midwest for cash flow, but they don't look at the value and what's surrounding it. And is this area going up, or they don't seek the expertise, because you can get 1% rule. Doesn't make it a great property, because when the furnace breaks, you're not getting that 1% rule for like 4 years. I mean,
right. Yeah. And I mean, and 1% rule should probably be like your minimum standard. Like, no, that's not, if you hit 1% rule, then we're good. Like, that's just where you're starting. You're filtering them off from there.
Yeah.
I mean, every time I hear 1% rule, I end up going, it probably should be 1.2.
Yeah, I mean, and also market dependent, because here in New Jersey, you can't even sniff the 1% rule, but you're going to get a huge scale on appreciation year over year still. So we have to explain that to people. It's like, hey, which bag do you want to choose from? And, maybe you can break even here and still be, still go up, but it depends what you want. Maybe you need the cash flow.
Yeah. And understand that real estate is not, you do not want to own real estate and not have cash to service it.
Yeah.
Because now you're somebody else's deal.
Yeah. Yeah. So how did you get started? I know your dad was the first one to kind of tip you off to it. What was your first kind of look at real estate?
It was growing up around those apartments, man. It was mowing the grass. It was getting into the, watching. Well, at first it was watching him deal with the tenants and have those conversations. I mean, so he operated a auto repair shop on the property, and then he had, I think it was like 12 or 15 units around it.
Oh, cool property. Yeah.
Yeah. And so he was running that business. And then he also would have, tenants walk in. So I'd see those interactions. And, I mean, he bought that when I was 4. And then I think I started mowing grass there when I was like 12. I was something like that, 12 or 13, trying to make money. And then that just got me in that world. And, I like cars, just didn't really want to keep working on them. And then that was the other thing I knew how to do. And we started at the wrong time, and we started in 08. But, I mean, a friend of mine that was a close friend of mine, he had been in real estate for a while. He goes, actually, this is one of the best times to get in real estate, because what you're going to learn stuff that most people never learn.
That's a good point. Do you feel like, because I grew up the same way, my dad was dragging me to investment properties, talking to tenants from like the time I was a kid all the way up, and then I started collecting the rents. Do you feel like you saw the landlord-tenant relationship more like kind of humanly than other people see it? I feel like there's a lot of new investors who get in and think it's very transactional, but there's really a human aspect to landlording, especially when you watch it. My dad, like, he would let people go 6-7 months without paying. He just felt bad. That's not really my bag, but I don't like being a landlord.
Right.
I know that now, but I did get to watch him negotiate all the time, collect the rent. And then I could see for myself, oh, okay, they're handing him money for this that he owns. So even as a kid, I kind of had a better idea. Did it work that way for you, that you just kind of through osmosis knew more as you got older?
Yeah, that was so, like, when in 08, when we had started kind of looking at doing more investing in 07, which obviously it turned out to be the wrong time.
Yeah.
But when we were doing it, I had planned on not being a property manager. Now I'm a certified property manager.
Yeah.
But So, I mean, we had just started interviewing some people, and what I realized is the amount of experience I had. There was so much that they didn't know to ask that I was asking them. And this was also, property management hadn't really taken off, uh, and really fine tuned and got better, to like what it is today. Back then, it was still kind of the Wild West. So yes, I mean, the direct answer to your question is yes. I mean, there's just stuff you figure out, and it's always a lesson learning. And there's a lot of even Stoic principles that I have picked up on in ways to maintain a human element and still have a direct conversation.
Yeah.
Being kindly honest. Now, I haven't been great at that, but I've learned a lot more from my wife about that. But to be able to have a direct conversation and do it in a kind way, it maintains their humanity and their dignity. But at the same time, you're not doing them the disservice of lying to them.
Yeah.
And
it's a really good point. Women are better at that, though, in general than men. It does take some learning on our behalf to kind of, sometimes you feel like, oh, well, I just have to be tougher, but you're going to get way more by doing it like you said. And I like the way that you phrased it. Kindly honest is like you said, yeah, you're not going to make up a story. I'm going to hit you with the truth. I'm just not going to hit you with it. We're just going to have a conversation about it. I think it adds a lot more trust to the relationship, no matter whether it's business to business, landlord to tenant as well.
Well, and I mean, along that line, you either get trust in a better relationship, or you expose the tenant is just manipulating you.
Yeah.
Like,
yeah.
I mean, if the tenant, if the tenant respects you and they're working with you, and they in return are honest with you, that's a good tenant. Even if they're behind, work it out. You may earn some loyalty points on renewals and stuff like that. And at the same time, if the reaction is negative, just be okay listening to that. Like,
yeah. And then make a decision afterwards. Doesn't have to be right then,
Mm-hmm.
Yeah, that's a good point.
And the writing's usually on the wall with those people that are negative, or having a negative reaction. I mean, typically they're not gonna. They could be one of those, I call them professional renters. Like
I was just about to bring it up. Yeah.
they can pass all your due diligence with flying colors, and they get in there and they morph into who they really are.
Well, they're just doing the same script they've done at other places. Oh, there's an asbestos issue. I might have to sue. Like, I've heard that one before. We've all heard them all
Right.
At this point.
Yep.
Oh, do you know what? The second they bring up constructive eviction after they've been there 1 month because of noise, you're now like, oh, I see you've done this before.
Yes.
But
and by the way,
yeah, go ahead.
I was going to say, and by the way, please tell me what you think a constructive eviction is.
yeah. A stereo on 7. Don't think that's going to cut it. But look, it's a great point for property management, because the thing that I don't like about being a landlord is everything, but I really don't like that awkward, I'm going to avoid the conversation that you need to have. I could be kindly honest, but I just prefer to avoid it because I'm not a people person, and that will put my property in jeopardy. My dad always had the conversation, and as long as the people were honest, he let them go, and we would fix it later. But we never had a walkaway tenant. We lost some money here and there, but most of them caught up because he was nice. But it's tough, and that shines a light on why property management is important as a buffer, because when it comes down to it and you've never been a landlord and you have to, someone, there's like suicide or something bad happens in the property, like you're going to have to deal with it, but you'd rather avoid it. I know I would. Is that kind of part of when you're talking to people about large scale, what they like about management, it's removing the thing that they don't want to do anyway. Hey, it's Jonathan. I hope you're enjoying this episode with Ryan Cadwell. And if you're in the Indianapolis area and you need help with property management, or you're looking to do some deals with development, get in touch with Ryan at Resolute RDM It's pretty simple. Once you get there, there's a phone number in the top, an email, and then obviously if you're already a customer, you got your login. Go check it out. Let's get back to the show.
The place where a lot of people get caught is they evaluate that rental just on the spreadsheet.
Yeah,
they don't want to include the PM fee because they think, oh my God, I can't pay that much per month. and well, the answer is, okay, well, I'll charge you less if you own 40 doors or, 100,000 square feet that we can manage for you. If you don't have economies of scale, then we've got to do something else. But what you don't realize you're trading is you're trying to say, I'm going to save that money. And then you're going to take on the job of knowing how to artfully deal with people, legal regulations, federal regulation. You're mixing all that into a bowl. And if you actually thought of that and then said, oh, that's all I have to pay for that. That's really, and I'm more of an investor on the outside. I would rather pay someone to do that because what you pay versus if the manager knows what they're doing and they have the people skills, they know how not to react. They know how to, They know how to, our systems are built to where as much information as we can, we try to keep a recording of it so that the communication, there's accountability. The tenant says, oh, you said this. Okay, when did we say that? We look it up. If we're wrong, we own it.
Yeah.
Most of the time we don't. Most of the time it wasn't said.
Yeah.
But yeah, that's the art of the business. And we've just kind of had to migrate away from caring about an owner who just price shops. If you're price shopping and you're not interviewing us for value,
terrible client. They'll be the worst.
You're right on.
They'll be back the next month saying, oh, Bob down the road said they could do it for $11 less or 1% less. And it's like, okay, go do that.
Well, how much is that 1% going to cost you in the long run?
Exactly. I always say, if you want a discount, you're going to end up with discount service. I think that pretty much goes across. And we're not talking about little discounts like, hey, you have 40 units. Yeah, I'll give you a break on that. That's just a smart business decision. I've found, and I want to get your take on this, I found that a lot of people, they get into landlording knowing that it's a business, but thinking that it's more kind of like a passive investment. And maybe it is if they have management, but still they're not managing the manager. But I don't think that the actual DIY landlords realize that now they just signed up for a second 9 to 5. You have 100%. Your 9 to 5, now you have a 5 to 10 and a weekends job and your family hates you. And that's why you probably get a lot of those. But also, they also don't want to pay. It's like, do you realize how much more time you can have with your family if you're not unclogging a toilet, which, P.S., you're not good at. You're not a plumber. That's why you keep going back.
Well, and to that end, they only do that because they think it's a 9 to 5 or a 10 to, it's actually a 24/7, 365.
Right. Yeah.
And then you have, you're at least on call for all that time. But then you all usually, got to give them props because they want to work hard. I never knock that, but they're usually not valuing their time properly. To where, if you weren't dealing with that, what would you be doing? If you,
yeah. How are you going to get? How are you going to get to time freedom, which is what everyone's really after? If you have your 9 to 5 and your 10 to 6 on weekends, and again, if you have a family or a partner or even friends, you're going to be the one who's in the middle of a kid's recital and you have to leave, because if there's an overflowing something and you don't have things put in place, it's you. And that's where, even for me, 50 years in, some days I'm like, I don't want to own, I don't own that as much as I used to, because it is a hassle. And what I do own, or, I invest in syndications now because that's a better move for me now. But I think a lot of younger people who have disposable money may look to things like that instead of direct. Because wouldn't you agree that even if you have properties and you have a good property manager, you still need to, have that daily dialogue, weekly dialogue with your property manager, because the bad ones are you're going to find out, later that a lot of problems are there. Because as you said, the industry has grown. There's a lot of better providers, but still there's a lot of that aren't.
Yeah. And I mean, that's even a catch-22, because you want it to be a point of the skills that we really want clients to have are more of an asset manager role. Like, understand your money, understand why you're putting it there, understand the returns you need to be getting, and let's work that. Because at the end of the day, saving a few $100 or $1,000 here or there, yes, it matters, but it really doesn't matter if you're worried about the right things. And that's the hard part, because property management, and whether it's painting buildings or, resurfacing, whether it's making those decisions, like, everybody thinks that that's the easy stuff. Like, oh yeah, that means I'm involved. But the harder stuff is really understanding your financial situation and knowing what you want and making sure that this is still part of that plan.
Yeah, I think people hold properties too long. If you don't like the property, just get rid of it. Like, if you bring me an investor who has 5 properties, I know they hate one, and they're just like, oh man, I don't want to sell them. Like, why wouldn't you just? They're because I'm at break even. Who cares? You don't like it. You'll get the deposit money back and the appreciation. Like, just sell it. Who cares? They get like tied up in it, like as if, because that's what they saw as their path to financial freedom. But if you have 5 and one's a dud, why don't you just trade it for something better?
Well, and I mean, you just mentioned it. What is it that they really wanted? They want freedom.
Exactly. And they're holding themselves back by, like you said, by not being an asset manager. You're right. Yeah. I really like that, because if they can manage their assets and they find a good property manager, that is going to be passive-ish, like pretty close to passive, especially if you have a good relationship. And then you can just, again, every year you should be sitting down. Here's my assets. I always tell people, rank all of the properties that you own from 1 to 10 and how much you like them. Then rank them and how much money they make you. Now look at both of those lists. If you hate one and it's 10 and it makes you the least money, sell it. I mean, it's a no-brainer. Right. But it is hard to get people to wrap because they think that's, well, it's going to pop one day, 7 years in, and it's still the same value.
Well, and it that falls into like the ego category for me. And do you like to talk about, I have 10 rentals at a party? Like, is that part of why you own them?
Doors culture is very high. I mean, if you go on Bigger's Pockets, it's, not as much anymore, but in the old days, all people talked about was how many doors they own. People still do it to me, and I'm like, I've never known how many doors I own. I just know it's a lot less now, but when I had a lot, you could ask me. I don't know, because why do you count a door? If you own 10 doors, but you own 20%, that's 2 doors to me, not 10. You know what I mean? Like, I can do math. And I do think it's a vanity metric, just like followers on social media. Like, half of those are fake. What do you want to own a dud? Would you rather say at a party, like you said, would you rather say you own 10, but 5 of them suck? Or will you just like have 5 good ones? I'll take the boring easy, all day. I like the point. It's great.
Oh, 100%. And that's the hard part sometimes for me. If somebody's, I own this, blah, and my first thought is, well, I don't know how you bought it. So what you paid for it, what your leverage is, what your cash flow is.
Yeah.
Like, I don't know anything about that. So like, you could be going, I could be talking to you in the bar because you're drowning your sorrows.
Yeah, I mean, two people could buy identical properties on the same block, and one could be crushing it and one could not with the same rents. Just depends, 100%. Like your great point, what you said. It depends on what they got in and why. It's an interesting business. I mean, what's your favorite type of property for yourself? Is it single families, multi-apartment buildings? And then what do you prefer to manage?
We're moving away from SFR a little bit. just more so because we're trying to help. We want to help our clients like level up, become the asset managers, put them into different deals, and and commercials that there's a little bit more opportunity. Actually, there's a lot more opportunity. There's
I agree.
opportunities in certain versions of that where
Yeah.
if you buy properties that aren't necessarily qualifying for the big boys, right? But you still run into some of the DIYers that just aren't operating at good levels. And as long as you get in
Yeah.
at the right numbers,
like
I found that
18 to 30 unit apartments, that type of thing. The big guns don't want that. I mean, that's a lot of units. People usually can't manage them themselves. Or are you talking about other commercial assets?
that or even retail and office, neighborhood office.
Yeah.
I mean, we've done a lot of that. We're in the works of repositioning some of those right now. I think for me, the reason some of those bigger things, some of the ones that are a little harder, that larger barrier to entry.
Yeah.
You just can eliminate a little bit of the competition with the dumb money we were talking about. That's willing to overpay, without really realizing if you overpay, the only answer to that's time.
Yeah. Yeah. And if you have it, great. Well, if someone was coming to your MSAs, which is Indiana and Missouri, a couple parts of those, what do you think the best opportunity is now? Is it that office retail, which is very low on the price scale, but still for some people might be hard to figure out how to reposition it to make the money, since, we lost a lot of that during COVID and maybe not everybody's back to work. I particularly really like that option. And a lot of people have been on saying it's a good one. What do you think about for the Midwest?
In our market, office is positioned right at the beginning of expansion phase. So there's going to be a lot more growth opportunity in those assets. Again, as long as you're buying them right, location matters. Working with the right professionals, all of that stuff matters. The multifamily space for us, they're in hyper supply. I mean, we've overbuilt to the hilt, and it's still going to take some time for everything to cycle out. I think the multifamily space it's still waiting on wages to start to help regulate that. Like, that's one of the things that a lot of people don't realize is rents are constricted by two things. The first one is jobs, but the second one is the wage. And whether or not, if wages aren't increasing, they don't have any money to pay higher rents. So you can't just jack rents up.
Especially, when all the new inventory is new, so it's higher priced, and then all the C class are just kind of sitting there. They'll probably do okay, but they can't reach the aspirational ones that they want.
Yeah. And then you also, like in the multifamily space, you also have a lot of delivery of everything they deliver is it's a product.
Right.
And then your old
no one's building a
B's.
C. Yeah.
Right. So, but then you still have the market adjustment on when those are delivered. And in a lot of ways, it's just more about having the money and the positioning to be able to ride that wave out. I mean, if you're already in multifamily, here, again, when did you buy it? What did you pay for it? What's the plan? I mean, if you paid a lot and you had, you got a loan that's going to be coming due at the end of your 5-year term, you're going to be in a different spot than I've seen some of the syndicators locally, they pushed out some really good numbers, but when I think one of them was like an IRR of 32 or something ridiculous, but they bought it in 2017.
Yeah.
So, okay, well, that makes total sense because you literally rode the entire way. So,
yeah, right. Great job. But that doesn't mean you're getting, 32 every time. You're going to get, 16 next time.
Yeah. I mean, you rode that massive wave right when you should have, and good for you that you did it. But we're back to normal again.
Yeah. If someone came to you and they're brand new now, but they have capital to deploy and they know what they want, where would you guide them if they just want a guidance on kind of where to start? Because the landscape's different. I think everybody used to want to start with single family, but I don't know anymore that that's the best option for a lot of people because it can be a little bit limiting. I think you can learn a lot with less risk, but what do you think?
Um, I like to do those meetings in person and really and like listen to the things they're saying that they're maybe not like they're not necessarily wrapping them in words, but they'll kind of indicate the things that are that they really want. I mean, I'll give an example of some client friends of mine. When we sat down to kind of go through stuff, they thought they wanted to get vacation rentals, and that was the next thing. And the more we dug into it, I was, and they were even okay with doing the risk, the taking on risk of like other country
Oh,
vacation rental.
yeah, okay.
And I was like, and
That's
I just kind
aggressive.
of yeah, and I just kind of took them through. I was like, well, just don't assume that they have American laws because they don't. So, like, I can't even advise on that because I don't know what risk you're actually looking at if you bought one of those.
Yeah.
But the more we got into it, the more it was a discovery session about the assets they did have. We could reposition those, make them some more money, and then they go on vacations anywhere in the world they wanted.
Yeah.
And so it a lot of times it's the fun part for us isn't just about helping people buy and operate. It's letting them kind of discover where they want to put their money and then how it's going to work, because you get the same benefits apply across real estate. It just depends on what you actually like. It's kind of like one of the things I learned early on in investing was, if you're going to buy stocks and stuff that you like.
Yeah.
Because you already kind of know how it works. For me, it was Apple. I understood Apple. I know when they did their launches. And then I just started watching the ticker and I'm like, oh, okay. I can clearly see that they roll everything out in September. They start selling it in October. They hit their
Yeah.
major in December. Like, but it was all just because I liked it. And so some of it's okay. You got the money. That's great. What do you like? And
Yeah.
what do because this isn't just going to be a short-term thing. You're going to buy it and you're going to hold it for a while. And, it could be like a marriage. You're going to have good stuff. You're going to have bad stuff. And
Yeah. Yeah, I agree with that. I was the same with stocks. I mean, I've almost never lost on a stock because I just bought stuff that I liked and I just waited.
yeah,
I made because sometimes I'll buy low, but I can look at things and be like, I mean, I'm buying this. The avatar is like going to still buy this. And I still invest in, I invest in a lot of index funds to just lay it out off the table, but I still have my own play account. I mean, that's what's fun. But I think the same with real estate. I think if you have an asset that you don't like, you're going to inherently pay less attention to it or pay less attention to the issues that come up. Property manager will tell you, hey, you need a new furnace. Oh, let's just wait till it breaks. Then it wakes and it breaks in winter and you pay the dummy tax on top of the furnace. So, I mean, it just makes sense. But I think we talked a little bit about Stoic philosophy, and I think that patience is really, really important when you're doing this advisory role, because like you said, they started out, someone else could have said, yeah, it's a great idea. Just invest in any country. That's a disaster. They have to figure out what they like through questioning and patience, because sometimes you just have to let them, give them some resources, see if they're even doing the work. And if they're not doing the work, again, it will go on us as advisors. Like, it will eventually be our fault if we press the foot, for them. Do you agree with that?
100%, 100%. Yeah. And it's, that's actually the fun part for us is you get in the discovery set. I mean, you get beyond the transaction. Like I'm just not that transactional.
Me too. We're
Actually, I
very
suck.
similar. Yeah. I'm the
Actually, I
worst
suck at it.
salesperson ever. Yeah. And I do a lot of business, but I just don't care about the sale because that's not important. It's like, is this a good asset for them? Are they happy about it? You know, what's worse as an agent or broker or anyone involved in the transaction to go to closing with your buyer, client, investor, and they're not even happy.
Right.
You're plunking down 800,000, you know, and you're not even in a good mood. Like, this is a great asset. You should all be excited. It's just,
Yeah.
you know, it's you're betting on your future and you're just like, hey, what are we going to get for lunch? It's like, oh, okay, all right. I like lunch too, but I hope it's a celebration, not you know, that property sucks, but it cash flows, because that's never going to be a great one.
Well, and you know, and hopefully they're having, you know, they're applying their stoic indifference, and they're not getting too high on the highs, and that will also reciprocate where they don't get too low on the lows either.
Yeah. I mean, I think it's important. You can always go too far, which I've gone too indifferent in my life.
Yeah.
You know, you can't just get too stoic, because then you're immovable. But yeah, I mean, I think it's important, but it's really a good point, because, you know, the research that I did on you is like, you really like to be that guide for people. And I like that too. I think that's part of the fun, because you always see this part with a real estate investor when you're mentoring them or talking to them, where like the light bulb goes off and they just get it. And then you're like, we found the thing for you. You now like that. You know, I'm sure you've seen that. Then it feels good. And now all of a sudden your due diligence and your excitement, it just motivates them, and they're really going to get into it, as opposed to like, you know, doing a week long of research on Section 8 multifamily, you know, short-term rentals, just kind of, you know, kicking every tire in the bin.
Yeah, I mean, if you do something you love, you never work a day in your life, and you can apply that into real estate, and then fine tune it down into specific types, and there's so many ways. Like, you can invest in notes and buy mortgages, and like, there's so much stuff that you can buy, especially if you're just honest, like, I don't want to buy this, but I need to put X amount of dollars into real estate somehow.
Yeah.
I mean,
I think there's way more vehicles than people think. I mean, I've had industrial people on, and just the amount of classes inside industrial would blow everybody's mind, because they think of it as like, oh, there's just one. It's just like that building. No, there's like 30 different kinds of industrial, all different ways. It's like business buying. There's a lot of different ways you can make business. And I think it's the exciting part of real estate. And I like knowing my own market, you know, and I like for people to want to know the markets that they're investing in, even if it's not local. Because like I said in the beginning, it's hard for someone to, you know, they live in New York City and they're like, oh, I heard the deals are really good in Indianapolis, but they just don't want to learn enough about the submarkets to know whether they're going in the right direction. We've seen that in cities around here where, you know, you could go one way and be down 20 grand in a year, and you can go the other, you might be up 35 grand, but it's just 2 blocks.
Yeah, I was going to say, yeah, that's street to street downtown Indianapolis.
Yeah, that's Philadelphia too, which I'm very familiar with that. It's exactly the same. And you can watch, when you go there, you can see the neighborhood break when you're driving. And it may change, but like, these are things that visually, again, I grew up with a dad who was dragging me to yard sales. You know, you grew up mowing the lawn. We're looking at the property and seeing what happens, how it deteriorates, what really happens. And I think that's you know, again, we're just trying to deliver these memories of ours for other people. Like, real estate's awesome. It's sitting under all these buildings, but the buildings just don't upkeep themselves.
Right. And once again, you got to come back to, like, what was the point to begin with? It's usually freedom of your time.
Yeah.
Like, you don't, and sometimes I watch documentaries, and you'll see some of these people that end up being landlords until the day they die. They're like in their 80s and they're still landlords.
Yeah.
And I'm like, that looks miserable.
I stopped a while ago, and it's just because they don't even like it. If we saw the doc and it was like somebody who he was great with the tenants, they were all his friends, and like that was like a collective thing, more power to you, even if your rents are, of course, undervalued, which they always are for those old timers.
For those people, yeah.
Yeah. But I mean, that's very common in self-storage. They're undervalued, but they're running a business that they like. They'll eventually sell it at not as much, and they'll be fine with that, and someone else will upgrade it. But yeah, I mean, I think if you take like a screenshot of our entire conversation, it's really about just, can you for a consumer, like, are you open to being advised?
Yeah.
Are you open to getting help instead of, an echo chamber where whatever you saw is now ratified? Because I find that to be more dangerous for the new investor, because there's just, when I grew up, there was no content. The content was my dad talking to me in the car. It wasn't on TikTok or Instagram, and then again, the algorithm plays into what you like. So if you're looking at multifamily, you're going to get jammed with multifamily. So of course, now you're going to think it's the greatest. And then they'll slip into self-storage. Then you click that button. Now you're down a self-storage rabbit hole. It's very hard to get out of the algorithmic pressure of what you're looking at unless you know people who can actually advise you face to face.
And the people that are going to advise you, are they going to have an uninvested interest in what they're telling you? Like,
exactly. Yeah,
they don't necessarily need you to buy into what they've invested in. There's also dangers in that, like, and just not seeing it for what it is, and that's part of the journey. I mean, you can't miss every bump on the trail, but
yeah. So at Resolute, who's your ideal client? Who do you want to contact you for assistance?
Investors that are looking to level up. Maybe they've had bad experiences. They want to learn more about investing, or they've already leveled up. They're fairly clear on their asset management. You need people to execute systems at a high level. Those are probably the two ends of the spectrum, and then anything between that. If the ones that don't work are usually the early ones that are convinced that that it's their way right now. And that's fine.
That's the same. I let them. Yeah, you can do that with somebody else. Doesn't work for me. Because what's the point of me giving all of my pearls of wisdom to someone who's not going to listen? It's just unfun. Is the best place for people to find you at ResoluteRDM.com?
Yep, or LinkedIn.
Yeah,
I mean, Facebook, Instagram, we're on all that too.
Yeah. When I was booking it, I kept reading it as Resoluter just in my head. And then I had to look at it and I was like, okay, yeah, Resolute RDM when I saw it. But I just looking at it like that. And then it clarified too. Awesome, man. I really appreciate it. It's been a pleasure having you on the show, and I look forward to staying in touch.
Yeah. Thanks, Jonathan. Appreciate the time.
Absolutely. That was Ryan Cadwell. He is a partner at Resolute RDM, and that's Realty Development Management. You can find them at resoluterdm.com. I'm Jonathan Greene. We'll see you next episode. Thanks for sticking around to the end so you can get a preview of who's coming up on episode 321 of Zen and the Art of Real Estate Investing. And it's Aubrey Linville of Linville Team Partners. Built for investors who want in, but don't know where to start. They kept hearing the same thing from clients. They wanted to invest, but they didn't know how, didn't know who to trust, and didn't know where to start. So this is where you can start now. We'll see you next episode with Aubrey.